On the podcast with us today is Justin Elliot. Justin, welcome to the podcast.
Thanks for having me, Dan.
Well, Justin, I'm looking forward to diving into this asset that you acquired back in August of 2020, which is called Midtown Point Apartments, located in Augusta, Georgia, 29 units. But before we dive into that deal, why don't you go ahead and give our listeners a little bit of a background about yourself and where you are right now as far as the multifamily side of things?
Sure. So I'm originally from Cleveland, Ohio. I live in Minneapolis, Minnesota now. But graduated from a school called Miami University in Ohio, and went to work for a big Fortune 500 company. Did the general manager thing, managing the P&L and growth for a location in Maple Grove, Minnesota, eventually. And then had a conference call one day where my CEO got on and said, "We're selling the business, so you got to look for something else to do." So did a couple things, went into medical device sales. I actually started a couple of businesses, and somewhere along the way got into real estate back in 2016, actually, and started with just small multifamily. So duplex, triplex, that sort of thing, and adding value and, fixing it up and selling it. So eventually I wanted to get bigger and got into the multifamily journey. And so this was the first one of the, hopefully the many.
That's cool. That's great. So this was the first one that you kind of added that was outside of that kind of smaller portfolio.
Correct.
That's great. Well, great. Well, I'm looking forward to diving into this one, and let's go ahead and just dive right in and kind of talk to us first about how did you actually find this deal?
So I would attribute finding this deal to networking, really. I'm part of a masterminds group, and I was always talking to people and seeing where I might be able to add value or partner, and, what are people's strengths and weaknesses and where can I help? And that's kind of how this one came about. I actually met Bernie Lund, who found this deal, who had single families in Augusta, Georgia. And he was able to get this one under contract. And actually, the first time I talked to him about it was when he was pitching me to be a passive investor in it. And so my angle is obviously figuring out how I could help, because I love the market and I wanted to be a GP on the deal. And eventually that's the way it ended up going. So we partnered together along with a third partner, Steve Chan, to raise the capital and get it closed.
So talk to me about how that conversation was like when he came to ask you about becoming an LP, and then all of a sudden now you're at one of the GPs.
Well, it was a really good deal. And I was interested in investing as an LP initially. It's been a strategy of mine to invest as an LP while becoming a GP, just to learn about the business. So I've done that. But I really felt like I could help Bernie. Bernie is so great at so many things, but I felt like the capital raise was a thing that I could really help him on. So it took a little while for him to kind of get me on board with it, because he was going to go raise this capital by himself originally. And but soon enough we talked about it, and actually it ended up that we had the same coach. So our coach really officially made the pairing with Bernie and I, and then the third partner, Steve, that came in to get the deal done.
Okay, great. So let's talk about, going back to kind of figuring out, I'm sure you had conversations with him about how he found it. How did he originally find this deal?
Well, it turns out, so he had 4 single family homes in Augusta, Georgia, and his property manager happens to be directly across the street from this 29 unit that he had heard about. And actually originally it got under contract with another buyer, and that buyer fell through. And then we hopped on board just shortly after that. And really we attribute it to the relationship with the property manager that Bernie had to get us that deal and let us know about it. And of course he wanted it because, every day he looks out the front window of his office and he sees these 29 units right across the street. So it was a good match.
Well, and it's interesting that you bring up the property management side of things, bringing a deal, because that's a kind of a hidden gem, if you will, for people who are listening to realize that it's not always just direct to seller. It's not always through a broker. A lot of times it can be through a third party for somebody who actually knows the market very well and sees these assets on a regular basis. And that's exactly what you did here. Is the property management company is the one who identified this property and was able to find a buyer that now they're able to manage that asset. So it's a win-win for both of you.
Totally agree. And it's something I tell people just starting out a lot is you want to focus on the broker relationships, obviously, but a great angle is to build those relationships with property managers. They're more likely to talk with you, first of all, right off the bat, because they want your business and they want to have those relationships with potential buyers so that they can find the deals. And then they're more likely to be the ones that manage it. So definitely reach out to the property managers in those markets that you're looking for to start building those relationships.
Now, going into the acquisition of this particular property, you identified the property management company presented it to Bernie, and he basically said, yes, let's move forward with it, got it under contract. At what point do you even know at what point an actual tour was taking place? Was it before he got it under contract, after he got it under contract, or where was that process with the tour itself?
I believe he toured it right after he got under contract. I caught up with Bernie right around due diligence time. So it was right when he was walking all of the units.
Mm-hmm.
So it was interesting because I had to come in and do kind of a due diligence after the fact. And so our due diligence, Steve and I, when we joined the project, was more, let's get out to the property, let's walk as many as we can, but we didn't have the ability to walk every single unit. So we had to kind of rely on Bernie and an inspector that he had out. And so we dove in more to the lease audits and financial due diligence that we really felt we could help with at that point.
Yeah. Now, when you did that lease audit, did you have somebody there with the property management company going through those leases with you?
Yes, the property management was involved in kind of giving us their opinion on things. We were diving into those details really to make sure that we had a real good idea of what we could do to increase rents and when we could do it. So one of the things that we've been focused on ever since the beginning is being very conservative with all of the numbers that we have attached to this deal. And the rent increases was one of those things. So those lease audits really helped us determine, when we thought we could get each rent increase. And we wanted to chart that out in a nice Excel spreadsheet and make sure we forecasted the projections accordingly.
When did this deal first get under contract?
This would have been June 2020.
Good. So the reason why I asked that is because I want to ask about COVID right here for just a minute. So
Yeah.
when you were doing your due diligence and going through your property tours and things, or your property walk, was there anything that had to be changed or modified due to the COVID-19 pandemic?
You know what? Not too much, really. I mean, obviously it was a little bit different going out there and getting on the plane and masking up and, making sure you're wearing a mask, and you wanted to be very conscious of invading people's space. So we had to make sure we communicated well with that. But there wasn't anything really that was too out of the ordinary from that. It didn't affect us too much.
There were no residents that complained or anything like that, or
no.
Yeah, that's good. That's good. So with this particular deal, did you guys have to put up any hard money?
We did. We had 1%. 1% earnest money was day one for that.
And it was hard day one?
No, actually, it wasn't hard day one. It became hard after 30 days.
Okay. And for those of you who are listening, we're not talking about like a hard money loan or anything like that. We're talking about this earnest money deposit that can go hard, meaning non-refundable at certain points in time throughout the process of this acquisition. So in this particular situation, you put up 1% for earnest money deposit, but then it didn't actually go hard or non-refundable until after that due diligence period, which I'm assuming was probably 30 days.
Correct.
Okay. So after the 30 days due diligence, and it sounds to me from the timeline that you guys closed this within 60 days. Is that correct?
We did.
Yeah. Okay. Because you got it under contract first part of June, probably closed it towards the end of August, and we're able to complete that during that time frame. During this due diligence process, what kind of issues came up during that time frame?
One of the things was electrical panels. They had Federal Pacific panels on the building, which many of you know if you've done deals like this before, that's not ideal. So that came up in due diligence. We wanted to make sure that was addressed by the seller. So we negotiated into the deal that they had to replace those before we closed.
Okay. And so they were able to change all those out before closing?
They were, yeah.
Yeah. Okay. What was the original purchase price on this one that was negotiated?
$1.4 million.
And did you end up keeping it at with 1.4? Did you do a little bit of?
No, we kept it at 1.4.
Okay. So 1.4 million, and you put up 140, not 140, not 10%. You put about 14,000.
14,000. Yeah.
Okay. 14,000 for the EMD. And other than the electrical panels, due diligence went pretty smoothly.
Yeah. I mean, there was the interior of these units need to be turned, but they weren't horrible. So due diligence was a lot about making sure we were real firm on our CapEx budget. Mm-hmm. So not really so much negotiations with the seller, but just making sure that we were raising the proper amount of money and we had it dialed in. So there was a lot of revisiting those budgets with the property manager, because they're the ones that are ultimately now helping us turn these units and add value, doing new floors and painting the cabinets, new appliances. So we spent a lot of due diligence just making sure we had those numbers dialed in.
What are you spending on the CapEx for the interiors?
So the total is 240,000, but that actually includes exterior work as well. Mm-hmm. So we just finished painting it and putting new shutters up. We had to do some parking lot repairs, some tree work for landscaping, but it ends up being about $6,500 budget that we're putting into each one of the 29 units.
And for that 6,500, you mentioned already, you're going to do new flooring, interior, and then you're going to do new paint. What about countertops and appliances, things like that?
New countertops, new appliances is the long-term goal. Although right now we're having trouble getting appliances because of the COVID, I guess, has made that go crazy. But we do have that budget in for long-term, and then we're just refinishing the cabinets, and we're also doing a new lighting package, new LED lights.
What are the current rents right now before doing renovations?
So going in, we had them at $636 on average.
And what's the unit mix?
All 2 bedrooms, with the exception of one is a 1 bedroom.
That's odd.
It's actually, that's an interesting story, because they had a 2 bedroom. They carved out one of the bedrooms to be a leasing office, and it's 29 units. We have a property manager right across the street. We really didn't think it would be necessary to have a leasing office, so we're turning that into a laundry room.
Oh, that's good.
There's no laundry on site, so we're going to put 3 washers and dryers in there.
Is there washer and dryer hookups in the units?
No.
Okay, so that's a great decision to add that.
Yeah.
So what do you, after doing the $6,500 per unit, what are you projecting to try to get the rents up to?
So we are projecting to get to $800 eventually, although we were very conservative with the numbers. So we actually don't have us hitting $800 till year 5 in our projections, but we're listing it. Actually just had a call today with the property manager. We're going to list these first 2 that we've turned and rehabbed for $795.
Okay. And the $800 per month, how long are you projecting to be able to renovate all 29 units time-wise?
We're giving ourselves plenty of time. We really don't have that happening until the end, towards year 5.
Okay. So it's like a slow kind of process over the next 5 years based on the model. Obviously, if you can accelerate that, you will, but
we're going to do it as fast as possible. Yeah. I mean, for us, it's a race to try to get these things, turned as fast as we can, move tenants into the new ones and start working on their old units, that sort of thing. But we wanted to just be ultra conservative with everything that's going on right now and the actual increases that we're getting. So we're going to get the work done, but we've got that timeline to really get those rents up.
Okay. What's the current occupancy, or before, when you closed?
It closed at about 94%. So physical occupancy wasn't a problem. Economic vacancy was an issue. Collections, as we're finding now, we're about 2 months into taking it over. The policy of old management was kind of pay whenever you can. So it's really retraining a lot of these residents to pay on time. So he did eventually collect everything from his tenants, but it took a whole month to do it. And so we're trying to change that currently.
What was the economic occupancy?
It was near the same. I mean, he was getting, 90+%. He was just getting it throughout the whole month rather than, on time.
What kind of impact did this property have during COVID?
It didn't appear to have much. I mean, he was definitely giving concessions. So, $636 rent was pretty low. The seller in this case he'd only owned it for a short amount of time, and he did a lot to the major things like the roofs. He repaired 3 out of the 4 roofs. He did a lot with HVAC. He made obviously the electrical repairs. He did some plumbing repairs as well. So he was really good at kind of taking on those bigger ticket items, but I think was kind of he wanted to get the building full to sell it, and he really gave up a lot of concessions to do that and didn't really focus on making sure people were paying on time or anything like that. That wasn't his business plan. It was more, fix up these big items and put some residents in there and then sell it.
Okay. And how did you end up financing this deal?
did Fannie Mae. So it's a 10-year fixed term, and it ended up being 3.8% interest rate. We were able to do it at 3.3, but that was a yield maintenance. So we wanted to do a step down. And so we paid a little bit more in interest rate, 3.8, and we were able to get 5 years of interest only.
That's good. That's great. So let me break down the thought process between the 3.8 step down versus the 3.3 in yield maintenance. Talk to me about what decision was made there as far as kind of the thought behind all that.
Well, the step down option, what it all comes down to, right? You plug it in a spreadsheet and you see what pops out as a better return. And we wanted the flexibility to be able to unload this sooner if we beat our business plan, right? So the step down, I think it's 5.5, 4.4, 3.3, 2.2. That's the step down. In other words, that's what you would pay in prepayment penalty if you sell earlier than that 10-year fixed. So just being able to do that, having the flexibility that step down prepayment, the numbers worked out better for us if we were to either execute on time, which was we underwrote it for a 5-year hold, or earlier, it helped us more.
So the reason why I'm asking this question is because it's an important question to kind of break down, because obviously with a yield maintenance, you are projecting that interest rates are going to continue to go down, correct?
Yeah.
So that in 5 years, your interest rate's going to be lower than 3.3% if you're doing yield maintenance, if you're thinking that the yield maintenance is going to cost you more. My thought process is, and again, I'm not saying your decision's wrong, I'm just trying to break it down to kind of understand your process, is at 3.3%, if your step down is 3% at year 5, because you're 5.5, 4.4, 3, right? On that fifth year, you're going to still have to pay a 3% prepayment penalty on the balance of the loan, versus here, you're going to only have to pay the difference between the 3.3 and the lowered interest rate at that time. So obviously if the interest rates go up, you wouldn't have any yield maintenance at all.
Right.
If interest rates go down, you'd have to have the interest rate down to 0.3% at that time to actually make it be better for you.
Right. I think our take on it was, like, in the short term, we think interest rates are going to go down. If in the long term, if they go up, we wanted to account for that as well. So again, we plugged it into the spreadsheet and see what's the IRR that pops out when we kind of did both projections, and the step down gave us more flexibility.
Okay. I definitely agree with the flexibility for sure. I definitely think that interest rates are going to go down. So I agree with that.
Yeah.
It's interesting to kind of, the hard part about underwriting when it comes to yield maintenance is you don't have no clue what the interest rates are going to be into the future.
Right.
And that's another reason why choosing having a little more flexibility and being able to actually plug in a number at year 5 and say, okay, we have a 3% prepayment penalty.
Right.
It's predictable. You know what it's going to be. Otherwise, really the yield maintenance side of things, you don't really know.
Right. A little unpredictability with the yield maintenance option.
Yeah. It's just interesting to kind of see different people's takes on that, because I look at it and go, I'd rather have 3.3% and not pay the extra 0.5% for 5 years, and then also have a little bit less. So it's a little more unpredictable. So it's kind of hard to really say for sure. But you'll know once you get down to that 5 year what would have been the option,
We will. Yeah. And I think the predictability was key. I mean, being able to know exactly what you're signing up for and knowing that the numbers work, I think limits your risk a little bit. And that's really the reason why we chose to do that.
What about the COVID reserve?
We did, it wasn't too bad. They had 3 options that they gave us. Let's see here. Look, I'm pulling up the 3 options that they gave us that had a mix of loan to value, basically 3 options that we could choose from that had different IO periods and different reserves. And we only had to carry 6 months of reserves on this for this option. So, in exchange, we did have a lower loan to value. We had to come in with 65% loan to value. We had options that gave us 75%. But again, those reserves were higher. So that killed the deal, in our opinion. It maybe not killed it, but this gave us a little bit more return being able to come in with less reserves and a lower loan to value.
Yeah, no, that's definitely good. And the reserve was on 6 months of principal and interest payments, correct?
Right.
Yeah,
Exactly.
that's the part that I don't understand, because you have 5 years of interest only. And I'm like, why don't you just take 6 months of my interest only? Because
Yeah, good
this
point.
isn't going to last for 5 years.
Good point. Yeah,
But anyway, they do what they want to do,
they
so
do.
they'll hold on to that thing for as long as they want to.
Yep.
All right, let's talk about how you structured it with investors. How did you kind of set this deal up to make it advantageous for your investors that you brought in?
So it's an 80-20 equity split.
Mm-hmm.
And that's it. There's no pref. It's just it's 20% that we're taking, and that's it. Pretty straightforward.
So 80-20, no pref, no hurdles or anything like that. No, really, there is
Nothing.
nothing in the waterfall. It's just 80% for the limited partners, 20% to the operator, to you.
That's it. Yep.
Okay, great.
Correct.
And how much capital did you end up raising?
$850,000.
So 850,000. And that was the down payment, closing costs, fees, and then also the CapEx budget.
Correct.
Correct.
Of 240. Yep.
240 in the CapEx. And how long did it end up taking you to raise the 850?
We got it all in by the day that we closed. So we probably had everything wired the week prior, like it always happens, right down to the last minute. But and we started our raise right around, I remember being right around 4th of July.
Okay. So a little bit kind of the beginning of July. And
yeah.
Let's see here. Now, when you're raising the funds, do you typically try to get it in a week before, or do you do it a couple weeks before, or what's kind of your usual? And I say usual. This is your first one.
Yeah, right. Yeah.
What did you set as your deadline for funding?
You know what? We didn't have a real strict timeline on that. That was one of the lessons that I learned with this, is that having a more precise timeline for investors is definitely advantageous. And if I had to do it over again, I probably wouldn't start raising as early, but I'd set my deadline sooner. So we were a little bit, we had 3 people that were working on the capital raise, and we had 3 different groups of investors, and we had 3 different timelines that they were all on, right? So it made things a little bit hard to manage coming into it. And in fact, like the last week, we had one of our biggest investors that was, of course, on vacation. And so we were lucky in that we had enough to close. So it didn't matter to actually closing the deal, but we really wanted to have a goal of getting everything raised so that we didn't have to raise after the deal closed, right?
Yeah.
So we ended up getting that, and thankfully for DocuSign, people can do things, or whatever the Hello Sign, whatever it is, they can do things on their phone now and get things wired pretty quickly from even on vacation. But if I had to do it again, I would definitely spend more time preparing for like the webinar that we did, and talking to people, having discussions about the deal prior to actually opening up funding. And I would shorten the window, right? So I'd open up funding, and then I'd close it down pretty quick and try to just shorten that timeline. I had 2 investors that dropped out. So here I was kind of early on in the process feeling really good. And then towards the end, I had 2 people that backed out, and I had to scramble to get 2 more people in to fill my part of the capital raise. And that right there is why if I did it again, I'd bump that whole timeline up a little bit, and I'd spend a lot of time getting the momentum for the deal in like that 30-day period. And then I just open it up for wire, and then try to close it down so that who's going to be in the deal plenty early. You're not going to the closing table, right, thinking you might be short.
Yeah, no, that's a great rule to live by. And what we do is we usually set our funding deadline about 3 to 4 weeks before closing. So we give our investors a good probably 4 or 5 weeks to review the offering, review the deal, fill out the PPMs, send in their funds, and then set a deadline 3 or 4 weeks before closing. It doesn't mean they can't come in if they come in after that, but it lets them know, hey, this is the deadline we need to have it in, or your spot's not reserved anymore, and we're going to bring in our backup investors to be able to fill in your spots, because we can't just wait on the sidelines.
Right.
So that, and I tell them, I said, the reason why we do that is for the same reason what you mentioned. I don't want to be scrambling the day before closing, trying to make sure we get the last little bit of wires in, and I want to make sure we get it in right away. Now, did you do this one as a 506 Bravo or a 506 Charlie?
B is in Bravo. Yep.
Okay. You did a 506 Bravo. How many investors did you end up bringing in?
I think it was around 12 or 13.
Average investment?
About 60,000.
Good. What was your minimum on it?
It was 50,000. So people were either in for 50 or they were in for 100. We didn't have anybody below or above that.
Okay. So 60,000 was the average. And let's see here. So thinking back to this entire project, that from the time that you kind of joined onto this project to the time you closed it, even up until now, like you're now a couple months into this, what other issues came up throughout the process that maybe we haven't unpacked yet?
We haven't had anything major. We did have some issues with the electrical work that was done. Luckily, it's covered under warranty from the seller, so it's getting taken care of. But we actually discovered when we started to go in and rehab these units that some of the wiring would be run to different units. So, it'd be like, unit 5C was actually going to unit 6C and vice versa, which was a problem. But we were testing that out as we were rehabbing these first two units. And then we had to go back in and check every single unit. But we were able to work it out with the seller to, make sure that got taken care of and the wiring was run properly under warranty. So that was a surprise, but it didn't end up hurting us. And other than that, it's been going, knock on wood, it's been going pretty well. We're under budget on these rehabs when we're turning them. The paint was completed. It looks great. The new signage is up. So, we kept the name of the building, but it just looks a lot better. And the laundry going in is going to be huge just to, I think attract that type of resident that we're looking for.
That's great. So two final questions that I ask everyone on the podcast. These are kind of contrasting questions. Is first off, what did you find that was what was kind of easier than you had originally had expected? Like maybe you originally thought it was going to be harder, but ended up being pretty easy.
I would say the financing, to get 5 years interest only, and the terms that we got, that was a huge surprise. So. And the process wasn't bad. I'm used to doing duplexes and triplexes and that sort of thing. And I can tell you that getting the financing done is equally as hard, if not harder, than it was in this scenario. So that went pretty well. That, by the way, I think it's helpful that we have someone on the loan that has a lot of experience in multifamily and someone on our team in our coach. So I think that had a lot to do with it. So I'd say that's what's gone easier than expected so far.
Good. And then the last question is what did you find that was maybe harder than you had originally expected?
I don't think I ever thought the capital raise was going to be easy, but everybody will always tell you'll have people drop out, right? So people will give you a verbal commitment or a hard commitment, and they'll tell you, keep going because, you're going to have people drop out. And of course, I thought my friends and family would never drop out, and they did. So I took my foot off the gas a little bit because I was in a position where I didn't want to start telling other people to get into the deal when I had it full verbally. And that goes back to the conversation we had about that short wire window, right? That short funding window, so that you're not playing games with yourself of, oh, do I go talk to someone else? I've got this verbally committed. They're going to come through, I think. So that whole timeline really was the thing that I now have thought through and formalized for future raises of how do you actually time this thing to make it effective and efficient?
I will tell you one thing that we do that has helped is obviously with the funding deadline and having a clear timeline is definitely important, but we have a 3 strikes you're out rule. So, and we actually let our investors know that, where if they actually soft reserve 3 times in a row and they back out, then they get it removed from our lists completely. Because we look at it and go, obviously, if you've looked at 3 of our deals and you've decided to back out 3 times, there's probably something that you don't like about how we structure things and how we put things together, or, maybe you just don't have the money to be able to put in there, but you're just trying to look at our documents, or I don't know. So we just decide that after 3 times, if you commit, if you say you're going to do it and you back out, then, that's it. It's 3 strikes, you're out. And we've actually had investors that'll call me up and they'll be like, I have to back out of this one, but please don't hold it against me because of yada, yada, yada. And then they're like legitimate, right? But they realize that, there is that 3 strikes you're out rule.
Right. Love it.
Yeah. So that would definitely something that would help you, but it hasn't completely eliminated the fact that we still have people drop out.
Yeah.
But my assistant who helps us with the investor relations side of things, she has a spreadsheet and she'll put their name down there and tell them the amount and the deal and all that kind of stuff of backing out. And so we keep track of all
blacklisted.
That way, they know that, if they do it 3 times in a row, they're out. But if it's not 3 times in a row, it's not that big of a deal. If it's one time, then you invest in the next one or something like that,
Yeah. And I think having contingencies is important too. So, people that might be able to help out with the raise and other parts of the deal, obviously, but having backups in place if you don't hit that first. And again, giving yourself plenty of time so that you have plan B is important.
Yeah, we typically raise about 15 to 20% more than we need because we usually have about a probably 10 to 15% dropout throughout the entire 60-day period that we're raising the funds. But it's always great to have that extra backup just in case those people back out because you usually will need it. So
right.
Well, Justin, it's been great catching up with you on this particular acquisition. I know you're going to have more, so looking forward to having you on again to be able to dive into some of your future acquisitions. But if somebody wants to reach out to you and kind of maybe dive a little bit deeper into this project or maybe follow you for some of your future acquisitions, how can they reach out to you?
Check out my website. I've got www.elliottmultifamily.com. Elliott has 2 L's and 2 T's. And for those listening that are maybe just getting started with capital raising or have never done a capital raise, I actually have something on there that's the 5 lessons I learned from my first capital raise. So that's at elliottmultifamily.com.
Awesome. Well, make sure that those of you who are listening, you go to his website, grab that little, what'd you call it again? The 5 lessons learned?
That's right.
The 5 lessons learned on raising capital on his first deal, and learn some more for yourself as you continue to grow. And Justin, I'm going to continue to follow you, obviously. And as you close more deals, love to have you back again and diving into some of those future acquisitions that you have.
Thanks, Dan.
All right. Thank you. Bye-bye.